Good morning, everyone. Thank you for joining. We will be starting in 2 minutes. Good morning, everyone. Welcome and thank you for taking your time on this Saturday for joining our webinar. And this is Jyoti here from My Time Equity. And in today's webinar, along with Sudhir Pai, we have with us Anup Naik from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slide that our attorneys mandate that we show prior to every webinar. If you have any questions during the presentation, please feel free to type them in the Q&A box and we will have them at the end during the Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti. Can you hear me well?
Yes, I
Okay,
can hear
okay,
you.
great. Very good morning, ladies and gentlemen. Thank you for joining today's webinar. As always, we'll present to you, what happened during the week ending 14 March 2025. So it was a roller coaster week. We saw the markets up and down. Good thing is on Friday, the market uh, closed with a very positive note. And that was primarily because of certain good information, certain good macros. First one was, there was no news about tariff at all on Friday. That was the good part. And second, the CPI numbers came out well. There is inflation, easing. We are seeing inflation go down month by month, which is a very good news. And it's the message to the Fed that interest rate cut should happen. And the initial jobless claims also came out better than expected to 220K versus 222K. So the week was not all that great. Both S&P and Nasdaq were down, but the closing of the week was with the positive momentum. Now the question is it a good time to put all the money in if I was sitting in cash, or should I be fearful of the market and get out of the equity market and convert everything to cash? Both the questions, the answer is it's not a good idea to do both because, markets go up and down with the noise, and there is a lot of noise these days, as we all know. The noise coming out of the tariff news, the Doge news, all the government jobs going away, and the geopolitical tensions. All of that creates a lot of news. While there is good news, market goes up. While there is noise and bad news, market goes down because traders are the ones who play in the market. They try to take advantage of the retail investors and the institutional investors, and also all the bots that play in the market to generate daily gains. They also try to create enough false impressions in the market. But what this market depends on is on the cycles. It's not something that goes purely based on macros or purely based on noise. It goes based on the earnings of the companies. So the earnings of all the companies, S&P companies, have been very good. But given the uncertainty of tariff, 40% of the CEOs of these companies were cautious. They were like, if tariff really comes into picture, the input cost may go up, which may increase inflation, which can bring down jobs because the interest rate will be high, and that can cause a little bit of, you know, uh, effect on the earnings per share of these companies, and the fundamentals of the companies can get into trouble. So that is why the CEOs were very negative, 40% of them, and that caused this, drop in the equity markets of almost 11%. So, with this positive news of geopolitical tensions, kind of there is a ceasefire going on. The discussions were positive. Both Russia and uh, Ukraine has agreed to a 30-day ceasefire. So the war has kind of stopped, but we never know whether it will be a permanent stop. So with that, with the inflation news, with the jobless claims to be better, overall, no news of tariff, and the debt ceiling, the government debt ceiling, that also has been aborted. So, there is no shutdown of government. So all of these positive macros and news has given a positive impetus to Friday. And we hope this continues next week. But we are cautious, which means our models are today in 5% cash and in hedged instruments of about 5%. So I'll take you through that in the coming slides. Next slide, Jyoti. Okay, so the title of today's webinar is Should we go global or should we stay local? So what does local means? Local means staying in S&P 500 and American equities, because we have seen US equities perform extremely well over the last 2 years. 23 and 24 were phenomenal years, giving a total return of about 40 plus percent, while other countries suffered. That is because most of the money got pumped into American equities because of Magnificent Seven, the strongest seven companies, because they don't need credit, they don't care about what is the Fed charging, and all their business comes from the entire world. And dollar was down, and in some years dollar was up. So the dollar impact, the inflation impact made the seven big companies do very well, and that gave the boost to US S&P 500. But this year, we don't think it's a good idea to purely focus on US equities, because as you can see on this chart, other countries like China, Europe, Mexico, and Canada, even though you keep hearing the news of these four countries all the time about tariff, you see these countries are doing extremely well since the inauguration took place. So that means there is something behind it, right? It is not as simple as the noise that you get to hear. If there is a tariff on China, Europe, Mexico, and Canada, why would these four countries stock market go up? Very clearly, the American money is going into these markets because tariff news is purely a negotiation tactic. And if there is a tariff, it's going to be a huge problem to US. And also this whole industrialization of America will happen because all of these companies may set up their companies here, and there may be, progress in terms of jobs and overall industrialization of America. So there is going to be, improvements happening to each and every country's, equity market. So we are going to look at all the foreign markets this year. And in our models, which I'll show you guys in some time, our models have good exposure in international markets. And we think, this year is not the year where you put all your money into S&P 500 and relax, because you may not get the best return. So diversification is the key, and going global is also something that one has to think of. Next slide, Jyoti. So, if you look at this slide, what this shows is the growth of Chinese market, particularly the Chinese technology companies and Nasdaq. The year-on-year growth and the year-to-date growth, is far better than Nasdaq. If you look at the first column, the Chinese technology companies are up for the year by 26.5%, and over the last 12 months, it's up by 48%. Whereas if you look at Nasdaq, which is all the American top 100 technology companies, the year-to-date numbers are down by 3.8% and up by only 10%. So, Chinese markets and Chinese technology in particular is doing extremely well. If you look at the European markets, even European markets have done pretty well. For year, it's up almost 16%, while S&P 500 is down by almost 2%. So this clearly tells you that there is a lot of value in investing in foreign markets, and which country in the global market is something that has to be analyzed. Fundamentals have to be checked, and based on that, investment have to be made. But there is a lot of opportunity in the global markets right now. That's what I'm trying to explain. Next slide. So this is about what you see on this slide is how S&P 500 has grown over the last 10 years. So one of the questions that I keep getting from my clients when they see this market turmoil is, should we get out of the market? Is this going to be a deep recession? Should we just exit the market and move into cash, or should we remain in the market? All these questions, all these panic attacks keep coming to us because we are invested in the market, and stock markets can really take a big downside if if it has to, right? If you look at COVID time, it was down 35%. So if your money goes down 35%, obviously there will be concern. But if you look at the long term trend of S&P 500 over 10 years, the average growth is about 13.24%, including dividends, and a total return of about 246%. So one thing is very clear, whatever comes down has to go up, whatever goes up has to come down. So I am personally of the opinion that we will hit the all-time highs before June again, and after that there may be a slight correction because of all the changes that are taking place, and that is a normal trend when a new president takes over. Change management really causes disruption, and that disruption will have its impact on quarter one, and then quarter two and quarter three does well, and quarter four depending on how but the history shows that Q2, Q3, Q4 all are good quarters. Q2 is usually a sideways quarter, which means you will not see a huge upside, but the other two quarters you should do well. But I think 2025 is going to be slightly different than the historical trend. I personally feel that we are going to see a bounce back next week, and we are going to see a better market, and maybe hit crossing the 200-day moving average and then hitting the 50-day moving average for the equity markets in the US. Next slide, Jyoti. Okay, so this slide tells you about the recession. How many times have we seen recession? If you look at this slide, we had 10% declines for 8 days during COVID, and in 2018, 13 days, we saw all the declines. But after that, it came back, very quickly. So, when you look at a correction, there have been about 40 corrections, of 10% over the last 50 years. But there have been only like about 10 corrections of more than 20%, which we call as a recession or as a bear market. If the correction is more than 20%, we are in a bear market. If we are at 10% correction, we are in a correction market. But usually, when it hits that 10% correction, it bounces back very quickly. And that is what history has shown us, and that is what this slide shows here. So be positive, but be cautious. Don't just start trading in meme stocks or small cap stocks or mid cap stocks. With all your money, the most important thing is diversification and playing the game the way smart money plays, and staying long in the market, not just get in and get out. Next slide, Jyoti. Next slide. Yeah. Okay, so this is a slide that I showed last week also. This basically says that, if you are out of the market for 10 best days, then your returns basically turns negative. And I have made these mistakes in the past, out of panic, when all your money is in the equity markets, you panic. And when you panic, you have a very, easy button to push, which is the sell button. When you push that sell button, you are done. All your money is in cash, but then you don't know when to get back in. And if you don't get back in and those becomes the best days of that year, then you lost that return. So, please don't get out of the market or don't ask us to get out of the market, because we manage your money very actively. We keep seeing when to get in, get out, and how much. And that decision is better done by us because we have got all that experience of mistakes that we have made in the past, all the good things that we have learned from, our mentors, our experts. And we are very, very comfortable with this market right now, but we are cautious. That is why we have 5% in cash and another 5% in a hedged tool. When I say hedged tool, what it means is if the markets are down, this particular hedge will take it up, will give you a positive boost. And when the markets are up, this hedge will go down. So it is like a double-edged sword. It plays the game of upside and downside both. It goes inverse to the stock market. Okay, but the crux of the matter here is you need to stay long in the market if you are an investor. And we don't deal with traders, and traders, have a different ball game. That is not what we believe in. Next slide. Okay, what all macros are we going to see next week? Very important uh, piece of macros that is coming out is the FOMC, or the federal government, interest rate decision. It's at 4.5% right now. The chances of an interest rate cut is about 60% right now, but there is not great hope that federal government is going to cut the rate of interest because they still think the job market is strong and inflation is yet to come to their 2% number. So I don't expect an interest rate cut to happen this time, but you never know. There is a little bit of politics there. We don't know if Trump is going to put some pressure, and there is yield curve dropping. So that the impact of Fed cutting the rate is already happening because of all the efforts of Doge that we are seeing, and other efforts of the Trump administration that we are seeing. And then there is also initial jobless claims on Thursday. And on Monday, we will get to see, the retail sales number. So that shows the consumer sentiment, then the Fed, then the jobs. There is going to be a lot of news. News will create noise. So, but don't get panicked. Just stay long in the market and be cautious. Next. So performance of our models, our equity models are doing better than S&P 500. If you look at S&P 500 in the first table, it is down 3.97% for the year. If you look at our models, the custom models, which is where most of our clients are, the custom IBKR model, which is the interactive broker model, is around 3% down, which is better than S&P. And the Schwab model is down by 2%, which is far better than S&P. And the one with the margin, where we take excess margin and then we trade, that saw a little bit of reduced number than the S&P 500, because the nature of that model is it takes higher risks and gets higher reward. That model was up like about 9.5%, like about a month ago, when S&P was up by about 2%. So S&P is a very, very, diversified 500 US companies, but our models have money in multiple models. If you look at the ETF models on the left-hand side, uh, we have international, which has done extremely well. For the year, it's up 8.5%. And if you look at metals and cryptos, gold and silver and copper did extremely well. That's why our model is up. Whereas Bitcoin did not perform well for the week. And Friday was a good day for Bitcoin and Ethereum. But before that, it was not great. It was down 2.59%. So because of the metals and crypto and international exposure, our models will do either better than S&P or be closer to S&P, because I think what will give a boost to our models is the innovative companies in the next generation model that you see on the left hand side, and the small and mid caps, which are value area, which is yet to kind of have a breakout and then do well, and then metals, cryptos. We have exposure to all of those four in our models, and that's why you see our models doing better than S&P 500, and is going to perform extremely well in a trending market. But right now we are kind of in a correction market. So, in a correction market, small caps and innovative companies and growth all falls because of the growth scare that we are experiencing right now because of the tariff news. Next slide, Jyoti. Okay, coming to the structured notes section of the webinar, we have this structured note which we had presented last week as well. This note is open and it closes on April 4th. And this note is on Meta, Microsoft, and Amazon. And this note gives you an upside of 300% if it goes all the way to the year three. But there are other breakpoints, at the end of year one, if all the stocks are flat, which means same price as April 4th, or positive, the bank will pay you 30% return. Does not matter whether it's up by 5% or 10%. If it is flat or positive, you get 30% return. Or if the stocks, one or all stocks are down, then it goes to year three. So at the end of year three, if all the stocks are up, then you take the highest performing stock and you get 3 times of the performance. And if one or all the stocks are down and it is not down by more than 50%, you just get your money back. You don't lose any money or make any money. But if it is below 50%, let's say if Amazon is down by 60%, then you end up getting only the remainder, which is 40%. So it is not a safe haven and it's not risk-free investment. There is no investment that is risk-free other than FDIC protected CDs, which gives 4%, or municipal securities or treasuries. These ones are high yielding, higher risk, but the risks are mitigated with the downside protection of 50% with a 3-year note. So you have 1 year out or you have a 3-year out. And these notes are very liquid. You can sell it any day you want, but we don't expect our clients who invest in these notes to call us after 3 days and say, hey, I want to sell this, because that won't get you the best performance. If you want total liquidity, equity markets is the best, or just keeping it in a checking account is the best, but that won't get you enough return. So these structured notes present you excellent returns and two different types of return. One is at the end of year one, it gives you 30% if it is flat or positive, or it gives you 3x, at the end of year three if all the stocks are positive, and downside protection of 50%. And this is issued by BNP. It's a very, very solid bank. And we have all the three solid companies, Meta, Amazon, and Microsoft. So I personally don't think we can get these kind of notes all the time. This was a negotiated note by My Time Equity, and we have more than $1 million already in this. So, if you are interested in something like this, you can do it through your IRA, 401k, or regular accounts, kids accounts, corporate accounts, any type of accounts. And we have to open an account with Charles Schwab, and $25,000 is the minimum investment to invest in this note. Next slide. Okay, so this is the S&P futures index. We have created a note on S&P futures index. We had presented this note last time as well, but the trade date of this note is March 21st. So we have another 6 days for this trade to close. So those who are interested in an index, but slightly more aggressive than S&P 500, because S&P 500 has 20% volatility, meaning the risk and reward depends on volatility of the index. So this particular index has a 35% volatility, which means when S&P goes up, this can go up much higher. When S&P falls, this will fall much higher. But what we are doing here, we are putting this in a structured note, and we are putting 50% barrier on it, meaning if it falls up to 50%, you don't lose your money. It is beyond 50% is when you lose your money. So for an index, putting a 50% barrier is an awesome protection. And this is a 5-year note. And the way it works is at the end of 1 year, if this index is flat or positive, you get 25% return or the actual return of the index. So this is the best part of this. So you get 25% flat, or if it is more than 25% return of that index, you get that. So I don't think there is any better index than this, which is high risk, high reward, and there is a 50% protection, and you get 25% if it is not done anything, or if it has done something better than 25%, then you get that, right? So this is a 5-year note. So we have multiple levels of protection over 5 years, and it's liquid anytime. If you want to get out in 6 months, you can. But again, my suggestion is not to invest in this to get out of it in 6 months. But if there is emergency, if you think that the Great Recession is coming and the markets are going to go down below 50%, then it's not a bad idea to exit. We ourselves may tell you. But I don't think we will know when those kind of times come, right? Nobody knew that COVID is going to take the market down 35%. And 50% is much higher than 35%. So even in a COVID kind of situation, this note has protection. So a very good note. Again, you can do this through any of your accounts. We have to do it through Charles Schwab, but you can do it through an IRA or corporate account or kids account and all of that. And a good diversification is to maybe put, some money in that Meta, Amazon, Google note, Microsoft note, or some money into this. So having a diversified portfolio of structured note is what I am trying to create for my clients. So there is some amount of money in equities, which is your money that you want phenomenal growth, long-term retirement account, and then, in case of emergency, you can liquidate it immediately and take the money out. And then you have structured note where you put your money, there is protection in case of downside, there is predictable return, and also liquid. Not as liquid as equities, but certainly more liquid than something like real estate or ventures, which is totally illiquid, over 5 years and 8 years, you can't take the money out if you're invested in real estate or ventures, right? Next slide, Jyoti. This table shows you the returns of S&P 500 versus this particular index, the futures index. If you see, this index was down more than 50% only once in 2008, the great financial crisis, and then it was down 42% in 2022. So we are kind of protecting ourselves with 50%. So hopefully that protection should take care of our best interest. And the returns, if you look at 2019, while S&P was 28%, this generated 66%. In 2013, when S&P was 29%, this generated 87%. So there is a good, prospect of this index doing extremely well. And even if it does not do well, even if it is just flat or positive, you get 25% in this note. So to me, this is a no-brainer note for a little bit of your money, which can sit in this particular index. So that is how I think the wealth management has to be done of each one of us. Next slide. Okay, so this is something new that I'm showing here. My desire is to show you guys something new all the time. I'm a very creative guy and I keep liking to, explore. I came across, an advisor who told me that a lot of his clients are in this particular fund. I was intrigued by his comment of, something which is tax-free return. And then this fund is called as the Ares Core Infrastructure Fund. Now, Ares is a $525 billion organization, so it's not a small company. They are like Blackstone and BlackRock and KKR, large company. And Ares has put together this fund, which is a $750 million fund. And this fund invests in the industrialization and electrification of America. So there is a great demand for electricity because of all the data centers that are getting built in America because of artificial intelligence and electric vehicles, electrification of all the transportation that is going on, and manufacturing coming back to America. Because of that, there is a huge need for infrastructure in the space of electricity. So trillions of dollars is going into solar, wind, natural gas power. What this fund does is invest in such projects. And this fund, this company Ares is known for its size, known for protecting investor capital. So what is the greatness of this fund? One, you know that the money that you are investing in is going in building America for electrification of America, which is very important. We have heard President Trump talking always about electrification. He is trying to drill as much oil from the US reserves, which is under his uh, project called Drill Baby Drill. That is why we see oil prices falling inflation going down. So this particular fund is investing in that space. Okay. So what are the returns of this fund? Now the return of this fund is paid on a monthly basis. So you get a monthly income every month. And then the return on an annualized basis is 10.7%. So you get paid 1/12 of 10.7 every month. Now the good thing is this is not taxable as regular income because they are treating this money as return of capital on the tax document. And when you cancel this investment and get back your money, that return is going to be a capital gain, which means if you hold this investment for more than a year, you will get a capital gain treatment on the money, which means you pay 20% tax versus 37% tax on regular income. Okay, so the returns are of two types. One is the yield, which is around 10.7%, which is the income. And then there will be about 2 to 3% growth of the fund's share price. And this is a very liquid fund. You can get out of it, anytime you want. But if you get out of it in year one, you pay a 2% early redemption fee. But if you want to leave after 1 year, there is no fee. You submit a redemption form and up to 5% of the fund's size, which is, let's say the fund size is $750 million, 5% of that, which is about $37 million, people can exit. And usually, nobody wants to exit because the yield is so good and liquidity is always available. And we can help you with this investment through Charles Schwab. And the minimum investment for this is $25,000. And this is only for accredited investors, meaning your income has to be more than $300,000 per year, or your total net worth, including your global assets, has to be more than $1 million. Only then you can participate in this fund. Whereas other things that I showed you, the structured notes, the stock market equities, those don't need you to be an accredited investor. But for this, you have to be accredited. So we look for your income statement, or we need to get a CPA certificate saying that you have more than $300,000 of income, or you have more than $1 million of net worth. Or if you are a single, then the income has to be more than $200,000 per year. Great fund, good tax treatment, very good yield for those who are looking for, I'm happy with 6 to 10% return. I don't want to take, exposure to equity markets. I don't want to give money to people and take the risk of lending money to smaller people. I don't want to keep money in the bank account and earn 3%, 4%. For them, this is a very good option where your yield is much, much higher and it is liquid all the time. You can get out anytime you want. This is called as the Ares Infrastructure Fund. Next. Okay, that brings an end to my webinar. We'll be happy to take questions. My partner Anup is on the line. I'll have to run. I usually do the webinar and then have to take up something else. So I will let Anup and Jyoti take questions from here. Over to you, Anup.
Yeah, I'm here. Let me just look into the questions. Is the future index note is called 5 times in total, correct? So just to be clear on the future, I'm assuming it is SPX FT356 index. So here it is auto callable, which means that if it is flat or positive in year one, it is called, and you get the returns, and that's the end of it. It will not be called 5 times. It is not a regular call. So it is likewise, if it is not flat or positive, or if it is negative in year one, it goes to year two. And of course, in year one, you get 25% or whatever is the return of the future indexes, what you get. Likewise, if it is negative, it goes to year two, where you get 50% or whatever is the the value of that particular ticker, whichever is higher you get. Likewise, it goes. So it is never called 5 times. It is just called once in the year between year one and year five. I hope that if that clarifies. The next question is there a protection for Ares fund like FDIC? Yeah. These funds are not protected, but historically, as Sudhir mentioned, they have given good results, but there is no principal protection. We are yeah, if there are any future principal protection notes that are coming, we will definitely let you know. Okay. What is the minimum investment on S&P 500 futures? Yes, for the first time investors, it is 50,000. The existing investors is 25,000. But please reach out to us, and we can definitely work to see how we can accommodate your request. That should not be a problem. Okay. Good. Will this webinar be posted or shared after I joined little late? Yeah, this webinar will be posted. We are planning to send it to the people who have or the clients who have registered for this webinar and could not attend or were late. We will definitely send it by end of day today. We'll also try to put it in the WhatsApp as well. Thirdly, we will also do a mail blast for all our clients tomorrow as well. So yes, you will get it. But in case if you have not got it, feel free to write to us or call us. We'll definitely send that across to you. Okay. Can we invest through old 401k? Answer is yes. Old 401k, IRA, SEP IRA, your individual account. It is possible to invest. Okay. Thanks for the clarification on index note. Okay, thanks, no problem. For MMA note, after 3 years, 25k becomes 25k becomes 75k or 100k. I did not get that question, but let me come back. If you can rephrase, that will be good. Meanwhile, I'll also try to come back after I go through the other questions. What is the ticker to track S&P futures? Again, it is SP FD356. If you go to our page, and if you go to the FAQs for structured notes, towards the end you can track the index live, and again, please visit the FAQs in the structured notes. Okay. What is the difference between infra fund and private credit fund? That's a good question. So the infra funds are primarily targeting for the infrastructure development that is happening in the US. It could be building of a road or a dam, or anything that is related to infrastructure funds. When it comes to the private credit funds, these are primarily those the big lenders from the Wall Street, like Blackstone, KKR, TPG. They lend, they are non-bank lending to the corporates, which are, like, for instance, the Blackstone and Apollo. They only focus on the upper market, like the big corporates, whereas the other companies like Monroe and TPG, they focus on middle and lower market. So they are primarily into the lending, whereas the infrastructure is for infrastructure development. Okay. I currently have my only 401k with Schwab. Will I be able to access or invest like a security, or do I need to create a separate account to invest in one of these notes? Okay, please remember, whatever we are referring to is the old 401k, not the present 401k. Yes, you can always roll it over. You'll have to create a account within Charles Schwab. We would be the custodian. We will help you to get there, get it set up, but reach out to us and we can definitely help. Okay. What would be the difference of using infra fund versus infra mutual fund or ETF? Look, these are all apples and oranges. You cannot compare. And as mentioned earlier in this call, we believe in diversification. If you are looking for diversification, be it in equity market, or be it in infrastructure funds, or be it in private credit, we can definitely we offer that, and we can discuss more on that, right? So your mutual funds and ETFs are more into equity, whereas infrastructure fund is a non-equity offerings. Okay. Infra fund, can you clarify if the entire return of capital is taxed at long term? Let's say we exit after 2 years, we are paying capital gain, or what portion? It's a good question. The way it works is, typically for the infra fund, you have the return of capital, till you are in the fund, but after that you will have to pay the capital gains, but that would be a long-term capital gain. So effectively, it would not be like your regular income. So for instance, you are on a 37% income bracket and you end up paying 20% capital gain. Obviously, there is a saving of around 17% on that particular tax fund. So that is how it is. We can definitely discuss more if you have any further questions. Between infra and private fund, which one do you think can provide consistent return? So we will go by the, again, these are two different kind of funds, and again, the way it is treated, especially with the taxation, it is a little bit different. Historically, all these funds have done well. So from a consistency perspective, these uh, companies have delivered, year, month on month and quarter on quarter. So yeah, this is again two different funds, but with the the partners that we are working with, they have delivered it consistently. Okay. Is 25,000 minimum investment for all these funds? Again, please reach out to us. We can definitely work. And we can definitely help you out on those minimum investment. Capital gain would be long term or short term. Capital gain is always long term. It is 365 days and above. Uh, that is what the capital gain is. Short term is the less than 365 days. These were the questions that I had. I am just trying to look into the one more question on the MMA fund. For MMA note, after 3 years, and after 3 years, 25K becomes 75K or 100K. Let me just go there and open that and talk about it. Just give me a second. Yeah, so the way the fund that is the trade is closing on April 4th, the way it works. So MMA stands for Meta, Microsoft, and Amazon. So if let us say if you invest 100K, and if the value is and on April 4th, if the the trade value is $10, that is a normal example that I give. As long as it is all three are up, within 1 year you get 30%. So which means that your 100K invested becomes 130K. If for some reason, if any one of these stock, which is Meta, Microsoft, and Amazon, if it is negative, then it jumps to the third year. Okay, and in third year, let us assume that Meta has grown by 15%, Microsoft has grown by 100%, Amazon has grown by 150%. So you'll always go by the least performing stock, as always in when you have more than one stocks in any structured notes. So since Meta has grown by 50%, which is least of all three, you get 3 times, and this would be exactly on 4th of April 2028. That is in the event that the note is not called at the end of the first year. So that is how you get uh, 3 times. So basically, for 100K invested, you get 150K gain. So effectively on around the last week of April on 2028, you will have 250K back in your bank account. I hope that clarifies. If you have further questions, more than happy to answer. These were the questions that I saw last. Okay, capital gain for SPX, we can come out even after 2 or 3 years. Technically, yes, but we generally say stay put for the entire duration of the the note, because it all depends on who is the buyer, and how is the secondary market treating you when you're trying to sell it. And if there is an emergency or so, we can definitely help, but we strongly suggest that your planning should always be for the entire life of the the note, and not that intermediate. That would not actually help you to your objective. What is the mean of note call out. The note call out is, as I mentioned in the example of okay, the way the note call out is for again, if we take the example of SPX, I think that is what you are looking into. If the SPX is flat or positive, then the note is auto called by the bank. So that is what you call it as an auto note call out, and it's an auto call, which means bank doesn't have the discretion to say, oh, I'll call, I'll not call, but it gets auto called when the SPX FD 356 is flat or positive. And there are certain notes where the bank has the discretion to call. So that is those are called as issuer discretion call out. Again, if you have more questions, we can definitely try to answer that. Again, I think there's a question again on the protection of Ares fund. As I mentioned again, none of them are FDIC protection, or your principal is not protected. But going by the history, they have done well. They have given monthly income, and that is what we can tell from the history. Anybody has got any questions, let me know. Jyoti, I think that is all I had. Nothing else from the questionnaires, Jyoti.
Thank you, Anup. Thank you, everyone, for joining our webinar today. And we wish you a happy weekend. Thank you, Anup. Thank you, Sudhir. Bye-bye.